Got the 305 shirt on.
Why did you take off the Miami shirt? I liked that shirt.
Morgan said I looked ridiculous.
You did.
You liked it, though.
Right. I didn't feel so alone for a change.
Hey, everybody. JC Peretz here, founder of AllStarCharts.com, and welcome back to Pardon the Price Action. Steve Straza joins us after a month in Asia. How's it feel to be back?
I was just going to say, it's been a long time, right? I missed this show. This is my favorite show. So let's do it.
So who's Michael Wilbon and who's Tony Kornheiser? How does that work? Who's who?
I feel like you're Tony.
My wife loves Tony Kornheiser.
He's more fun, right? I don't know. That's tough.
He's like so funny. All right, let's get right into it. Overhead supply. It has been a nice run for growth stocks this year, but some of the strongest indexes are now running into overhead supply. What are your thoughts?
I mean, look, you've been very vocal about the overhead supply, the very logical levels of resistance that some of the most important indexes in the world have been running into. And for 3 weeks now, we've struggled at these levels, right? So here's the market telling us that, yes, indeed, these levels are, again, important. We stopped, paused, and reversed at these levels during the last cycle, and now we're seeing it again. If you shift down, it's really, for me, you could talk about the other charts here, but go to the relative trends. This is not just a big level on an absolute basis for some of the biggest indexes in the world or some of the most important growth indexes. But on relative terms, we're running into .com bubble highs in some of these ratios. Like this is technology versus the broader market. You know, this is multi-year highs, prior cycle highs from 2020, 2021 in equal weight tech versus the equal weight. So this is a obvious place for corrective action to happen. And it has been. How long does it last is the question, right?
Yeah, and that's really what it is. And I've been in this situation before. Reminds me of gold, like in 2020, being like, you know, we're back at these levels. I don't know how long it's going to last. Even 2022, I think it was the last cycle. Yeah, 2020. And it's like, I don't know how long it's going to last. Could be a few months, could be a few quarters. Who knows? Maybe never. This is one of those situations. Here's technology running into this resistance on an equally weighted basis and cap weighted basis. And these are the biggest components of the S&P 500 and the NASDAQ. So for me, this is it. I don't know how long it's going to take, but as soon as it's done, the overall indexes can move on. In the meantime, I think we want to look underneath the surface at other sectors.
But that's a good point, right? The S&P 500 and especially the NASDAQ 100 are going to have a hard time going higher in the back half of the year if these stocks are not participating.
That's right.
Are we ready for industrials? Okay. Listen, one group that has been able to reclaim its highs, unlike tech from the prior cycle, is industrials. So talk to me about the recent price action in this sector.
You know, it's part of the original leaders. Remember when the new 52-week lows list bottomed out last June in 2022, off the lows, industrials were some of the leaders when you look underneath the surface. And, you know, the fact that we're now making new all-time highs kind of goes back to that old mantra. You know, the structural leaders will be the leaders from the start, you know, kind of like back in 2009 when the market bottomed, consumer discretionary and technology, you know, sort of bottomed out first and you had some relative strength there. I think industrials can maybe prove to be that, or at least maybe one of them. So the fact that we're already making new all-time highs above the prior cycle's highs, I think is encouraging for the overall market. So I got two things. The longer that industrials can stay above these levels, the more bullish it is for the overall market. Because if industrials are making new all-time highs, eventually the others, in my opinion, are going to catch up as well, ultimately. How long that might take, I don't know. But I think that they are sort of setting the roadmap, if you will. On the other side of the coin, what happens to this market if we lose industrials? I don't necessarily see enough evidence that supports such a thing. I'm not seeing it in financials either, for that matter. And I'm kind of grouping them together in this particular cycle. And we're just continuing to see strength there. So if we lose that, that might tell us more about the overall correction we're in. If we don't, I think it means a shallow correction and ultimately tech breaks out too.
Yep. I'm with you. Slide 16. I mean, you just called them secular leaders. They're definitely leaders of the current cycle, right? Look at this chart. This is the relative strength line between equal weight industrials and the equal weight S&P. New all-time highs. And we've been moving in a straight line higher for years now. right? So this has been a group that we want to be looking at, right? It's working all up and down the market cap scale, large caps, mid caps, small caps. And listen, when it comes to the rotation that's been taking place beneath the surface, right, out of growth into more of these value sectors or more cyclical sectors, industrials, I would categorize in that group. I think it's more, you want to be open to more opportunities, but you don't want to necessarily close the door. So even if industrials were to fail at the index level, look at the strongest industry groups. I just took a look beneath the surface at all the subsectors within industrials, getting ready for this video, and truckers have been on an absolute tear, right? They've been doing great, broke out of the structural basing pattern, making new all-time highs on a relative basis as well. Look at the truckers. Like, we just came up with one in the Young Aristocrat scan, which is out today. They pay a nice dividend, mid-cap trucking stock, breaking out of a nice base. We know exactly where we're wrong, 30-50 here. There's going to be opportunities, particularly in these groups that we can call secular leaders or cycle leaders, right?
No question. All right, dollar headwinds. The dollar was a tailwind these last few quarters, as we know. And now that the dollar index has reclaimed the former pivot lows, it's a headwind now.
So, we've been laughing a little bit. I've been saying to you, hey, is this not the most important chart in the market? And you're like, when was it not? And you're right. It's always important. But I think back to a time like last October, I think we have the chart here with the magazine covers. Yeah, right. So this was last fall, late September. Then we started chopping around in continuation pattern that resolved lower in October, maybe November. But this is when we were able to look at a chart of the DXY or the dollar and say, okay, the uptrend is over. We don't know what that means from here, but that, really strong dollar headwind that's been in place and holding.
How about those magazine covers, though, right? George Washington flexing, jumping out of a dollar bill. Hilarious.
Have we ever had more evidence of a top?
We got a lot of pushback from people like, oh, magazine covers, blah, 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 dollars in an uptrend. All right, bro.
And guess what? That was also bullish evidence, right? So we knew the dollar was rolling over. Then we kind of rolled over for a while. Now we chopped sideways pretty much all year. Now we're at a place where we're like, what's the next move? And I think if we're above those pivot lows, the next move might be higher, and that will be trouble for risk assets, right?
Yep, that's right. And here's that correlation chart, exactly what Straz is talking about. That dollar strength was really a headwind for stocks in 2022, particularly at the index level. And it's not a coincidence that when George Washington was jumping out of the dollar bill on the cover of Barron's, the dollar was literally peaking at the time. And that was the best time to be buying stocks, as we are now, as it's obvious to see now. But we've been talking about it the whole time, of course. My argument has been that the dollar is the most important chart. And Straz, I'm like, Straz, when is it not? So, all right, next topic.
Sorry, I didn't give you much time. I know you wanted to talk more about the dollar.
I said my piece. What do you want? Stronger dollar, it's going to be tough to make money in the stock market. I mean, what else you want him to know?
What asset class will have the most alpha through the back half of 2023? What are the intermarket relationships telling us right now?
I mean, energy's been kind of played that Notre Dame role. It's kind of cyclical, but I do my own thing, but I'm kind of in the ACC, but I'm not,
It's good at that. We see that. We see that pretty often, right?
Energy's kind of like that right now. So for me, it seems like that's that. I mean, I'm talking in my book. I'm incredibly long Chevron, very aggressively so. Have been, and it's been working. I've been adding to positions as well. So clearly I've made I don't own any financials currently. So there you go. So there's your answer. I think it's energy.
I mean, it's been the leader, right? Look at these reversal patterns. If this reversal pattern is valid in crude oil, next chart, or
this one, what? Relative or to tech, you mean?
Oh,
relative to growth?
Chart 32. Yeah. Right. If this is a valid reversal and we're going higher in crude oil, gasoline looks the same, by the way. The commodities index itself isn't too far off. If that's the case, you have to be in energy stocks, right? So if that ratio between stocks and commodities were to flip in favor of commodities again, it doesn't necessarily mean that there are not opportunities in the stock market. It's just not the stocks that you're used to there being opportunities in, right? It's not the growth stocks. It's material stocks, your energy stocks, industrials, financials, like you said. So,
And weren't energy stocks the leader off the lows initially?
yeah, like when you talk
years ago.
Yeah, when you talk about secular leaders off the COVID lows, that's energy. They just took a year off.
That's right. That's right. All right. So growth versus value. From a growth versus value perspective, how should investors be positioned? Is the recent rotation going to result in a sustainable trend?
It goes 39. So it's been all tech all year. 39. Yeah. And this chart shows it really well. Straight line higher. You can see it off the lows just back in January. And now we have what looks like a very short-term top. How that corrective action looks in the future, whether it's mostly through price or mostly through time, is what will really be the tell. So it doesn't necessarily mean that tech stocks are going to crater on an absolute basis, but it does mean that if this bull market is sustainable, there's going to be other better opportunities in other sectors. So if you flip through some of these ratio charts, we have some ideas here, whether it's energy, right? Or even if you go down to the financials and industrials relative ratios and the dual pane chart on 43. Yeah, I mean, look, very logical levels for some new leadership to be asserted here from these cyclical groups.
Yeah. And then new maybe for financials, old leadership for some of the others, including energy, which is, just really, really interesting overall. So the fact that now financials are participating on a relative basis, right? Look at that, huh? I mean, look at banks getting back above those 2020 lows, regional banks as well. What better bottom, particularly relative, what better relative bottom than a banking crisis that never actually came?
Think about what you're saying. These are the worst stocks in the market this year. And here's what they look like on a relative basis. Now you're going to tell me they're leaders? Probably not something you see in a bear market.
No. All right. So Straza, word association, is that what we're doing? This is you, right? This is what you like to do.
Right. This is a game that we like to play. I'm going to throw out a word or a phrase, and you're going to tell me the first thing that comes to mind. Listen, it was CPI day yesterday. Don't kill me. Today's word is disinflation.
So disinflation is the lower acceleration of inflation?
You studied for your GMAT, sir.
Yes. No. I'm asking.
Yeah. It's when there's still inflation, but it's at a slowing rate. That's disinflation. Right?
As opposed to deflation, which is lowering, which is the opposite of inflation.
Right, because we look at like the
See how I know that? Come on. How about that? You impressed?
So
Are you impressed?
So for the first time in 12 months, 12 months, the year-over-year growth rate in inflation ticked higher on a monthly basis, right? So the growth rate on a year-over-year basis this month was higher than the growth rate on a year-over-year basis last month. So for the last 12 months, that number has been decreasing.
Right.
Now, yesterday, it ticked higher. Now, it's not a coincidence.
Would that be a reflation? Is that what that's called?
I guess, yeah. We might be.
I don't know.
You could easily say to me, it's one data point, 1 month means nothing. But if it does mean something and we continue on in this direction, then you'll be hearing people talk about another inflation.
Listen, parents out there, if you're listening, whatever you do, don't let your kids become economists.
Listen,
can we do the disinflation? What's the word? What is your association?
What comes to mind for me is economists, right? Like you said. This is so easy to mess up. We saw inflation peaking and everybody was talking about peak inflation last summer. Now it looks like we're headed higher again. So where we go from here, I don't know, but I would look at those commodity charts for a clue.
We're getting a lot of mixed information from the bond market these days.
Yeah.
Are we? Where are rates heading from here?
I mean, look, you tell me, right? This is your chart from Twitter. This is really this is the world that we're living in as risk asset investors today, especially as like growth stock investors or long duration asset investors. This chart matters so much to you. If we break out here and the 10-year yield establishes a new range, right, breaks out of this old range from the past year and a half, there's going to be a new uptrend or new markup phase underway. and that's going to put pressure on stock price. If we roll over at the upper bounds here, I mean, that's a whole different world where I would expect all stocks to be doing pretty well. So the other side of the coin, right, is sideways as an option. Maybe speak to that a little bit.
Yeah, so that's really what it's been. Sideways. We can draw the nice little smiley face and a potential breakout. We can put together a double top and resistance. Like that's, anybody can do that. It's sort of dissecting, the higher probabilities or just waiting, right? And I think that it's been prudent to kind of just sit tight. I mean, bonds are really getting hammered, man. Even today on Friday, the 11th of August, as we're recording this, still making new lows. You got like the TLT, for example, making new closing weekly lows is what's going to look like. So there's no evidence at all, to Ian Culley's point over at All Star Charts, that we should be betting against higher rates. Like, in other words, we're not buying bonds. Like, that's definitely not what we're doing. If bonds were to break out and recover and interest rates were to start falling apart, maybe there's a bond trade there. But I guess since we're not doing anything, I guess it's sideways for longer from an execution standpoint in the bond market. And then the implications of how we're thinking of it is we need to err in the direction of the underlying trend, which is higher. Therefore, that rotation that we're talking about betting on, like industrials and energy and financials, makes sense from an intermarket perspective as well.
Yeah, I'm totally with you. We've been navigating the bond market throughout this rate hike cycle over the past several years. And I think the best piece of information, if you go to slide 51, has been developed European yields, right? So Germany's really been like leading the way, giving us some of the best evidence for where the US is headed. And the long end is going to move sooner than the short end, typically, especially as rates are moving higher, right? So the 30-year yield in Germany is going to break out of this little range here and make new highs. And that will be like the first tip of the hat that US yields might be resolving this range higher. For now, they got rejected again. If I showed you the Spanish 10-year, Spanish 30-year, the Italian, the French, UK, all of them have been rejected from their range highs over the past few weeks, right? So we're not ready yet, but those are the charts I'm kind of looking at for early evidence. And then also gasoline. I know we already talked about it, but commodities. Right? If commodities keep moving higher, the Fed is going to be forced to hike rates, and you're going to see the whole yield curve move higher again.
But everybody, Straza, is betting on lower bond prices. The speculators have the most aggressive short positions in history, and historically, when they're this aggressively short, we want to be taking the other side. So I don't know how comfortable I feel shorting bonds.
I hear you, and I know why I know why you weigh the COT data so heavily, because it's worked so many times in the past. But listen, I understand why the speculators are positioned the way they are. They're probably looking at the things that we just talked about. Like, a lot of the evidence outside of that, the sentiment, is starting to pile up more and more in favor of higher.
Yeah. No question. And yeah, no question. And we're trading it that way in the equities market, just not directly in bonds. And I got to tell you, if I want to put on a bond trade, which I may or may not, I would do so on a breakdown in bonds and a breakout in rates. Why not short bonds in that scenario? But I got to see it. And,
if tech stocks were really to roll over here and correct in a real way, rates breaking out of their range would make sense in that environment.
All right. Is that your hot take, or you got another hot take for us?
That was pretty hot. I'll come up with another one in the next 20 seconds. You go first.
Well, I thought you were going to talk about the XSOE.
Oh, thanks. Yeah, I'll do that.
So why should we care?
Oh, you want me to go first? So Wisdom Tree has this really cool thing. They have some awesome funds for international exposure, whether it's emerging markets or developed markets. And one thing that they do is they kind of pick out the state-owned enterprises from some of these indexes. They'll do it for, country-specific indexes. So their China fund, they pull out the ex-state-owned or the state-owned enterprises and have a China ex-state-owned. And even for emerging markets, they pull out the state-owned enterprises. After spending a month or almost a month in Asia in July, it's very real to me why that's important. These countries deal with geopolitical issues that we could never imagine here as U.S. investors. And it's a true concern. and you have to worry about it as an investor. What Wisdom Tree is doing for you is going and trying to pull those companies out of their indexes. And I think that's a better way to buy these emerging economies.
I like the interesting composition. It's 8% basic materials, 20% consumer cyclicals.
Yep.
Then you've got 16% financials.
Yep.
You've got 23% technology, which is still a hefty sum because you got a lot of Taiwan semi in there, Samsung, Alibaba. You got a bunch of banks, of course, Pinduoduo, JD.com. They're really, really interesting. 7% staples, 6% healthcare, virtually no real estate, which I guess is interesting. Only 3% energy. When you think emerging markets, kind of reiterating, it doesn't necessarily mean energy, right?
So
it's not your father's emerging market fund.
No, but I did read like the white paper, or I think it was more than just a fact sheet that they have over on the website. You can check it out.
Guy with his white papers.
No, what it becomes, though, is the ex-state-owned enterprises index versus the normal or traditional emerging markets index. It becomes a growth versus value trade, right? Because so many of the state-owned enterprises are banks or oil and gas companies or copper or natural resource miners, right? Those tend to be, it's the old economy businesses that are state-owned. So when they remove them, the index becomes much heavier towards the new economy stuff like technology, discretionary communications, etc.
I got a hot take.
Give it to me.
My hot take is that investors in general don't pay enough attention to what's actually happening in the market. I feel like investors are all like, "Oh, this is what could happen. This is what should happen." That's the worst one. This is what should happen. This is what could happen. This is what might happen. Why not focus more attention on what actually is happening, right? This index is making new highs. It's going up. This one is not going down. Remember how before it was going down? Now it's not doing that anymore. How come so many stocks in this index that were so terrible before keep breaking out to new highs, right? Why are we seeing these particular groups of stocks not going up anymore and now they're going down, right? In other words, actually seeing what the market is actually doing, because that's the only thing that's actually going to pay anybody, right? The could and the government is going to do this, or this is going to happen because of the government or the Fed or the Trump or the Yellen and the Powell. Like there's always like somebody and there's always like a thing, right? All that is fine, but maybe focus a little bit more attention on what's actually happening in the market between buyers and sellers, which determine the price of things. Contrary to popular belief, it's not that it's manipulated. There are buyers and sellers. You might not like who these buyers and sellers are. They're governments in many cases, large corporations, hedge funds. You might not like them, but they collectively are controlling the prices of assets, stocks, bonds, commodities around the world, foreign exchange. So I would encourage everybody listening to focus more attention. It doesn't have to be maybe all your attention, maybe a little bit more attention or a lot more attention to what's actually happening. That's my hot take. How do you feel about that?
It's a great point. You know, you're not getting any pushback from me.
All right, everybody. On that note, Steve Straza, welcome back to America. We missed you. We're happy to have you back. All the ladies are happy. You get Straza back, right? So there you go. Nice round of applause there for Straza. Thanks for watching. Make sure to give us a like and hit the subscribe button so you never miss an update, and follow me at All Star Charts on Twitter, and be sure to follow Steve at S. Straza. Leave a comment below and let us know what you think. See you next week.
Have a good weekend, everybody.
Adios.